Well, thank you very much, Simon. We're coming up now for our second panel, and also chaired by Neil. And everybody's here. So I'll just introduce our panelists. Ignacio de Calore of the IFC, Jeremy Russell we've already met, of Investec, Robert Figg of the LME, and Nicholas Snowden of Standard Chartered. So Neil, I think if you just take it straight from there.
Thanks very much. Well, we'll just get straight into it. Jeremy, I thought your presentation earlier was interesting. I mean, as you mentioned, it's been 4 years of underperformance for the mining sector against just about any indices you care to pick. It seems investors are underweight mining stocks. Those investors that are in the sector don't want management teams to spend. They want them to cut costs, return money via dividends. I mean, that seems a pretty gloomy sort of backdrop for investment and expansion. Can you just give us your views and perspective on the marketplace at the moment?
Sure. Okay. Yeah, it is a bit of a gloomy backdrop. I mean, we have seen the beginning of 2015 marked a 4-year bear market in mining equities, underperformance relative to every conceivable benchmark, as I said earlier. That is completely unprecedented in as far as we can go back, as far as we can see. And so far, 2015, unfortunately, having checked this only 2 or 3 days ago, is shaping up for the 5th year in that series. So we've seen mining equities, except gold, pretty much underperform every conceivable benchmark indices. So that is bearish. So, but I would say that the interesting thing, as I mentioned when I did my opening comments, is that the First Quantum deal of 1.4 billion Canadian dollars is a very, very interesting. It's the largest deal this year and the largest deal for a very long time. And the fact that First Quantum is, by definition, very, very much dependent on, focused on Zambia, is a huge vote of confidence in Zambia and what has happened since the royalty tax was changed. I think that's a very, very positive thing for Zambia.
Is it a vote on copper as well as Zambia?
Absolutely. And copper is the one metal where I think we're all in agreement that there is a developing deficit. By any benchmark, and certainly, if the world needs as much copper as we all think, you're going to have to see some very major copper developments come on stream. Oyu Tolgoi for one, the expansion, the various Chilean copper mines deepen, and they will require copper prices higher than they are now. So I think the outlook for copper is still extremely good, but investors still are very, very, very cautious towards the sector.
Okay, well, perhaps we can look at incentive pricing a bit later, but actually I wanted to just move to Nicholas now. Nicholas is the metals analyst at Standard Chartered. I just wondered whether you could just talk us through some of the challenges facing copper producers actually in this environment, the constraints on financing, the limits on projects that make sense at these sort of copper prices. I mean, it sort of strikes me that a greenfield project isn't really doable at these sort of levels. Perhaps you'd need something nearer 6,500 to sort of get the rate of return that you might want on a greenfield or expansion. Can you talk us through some of that?
Sure. Well, I mean, I think that question really sums up the reason why the investment thesis for Zambia is so strong. When you look at the copper market right now, clearly there are a lot of challenges on the demand side in China, but also Europe, and it's unlikely that those are going to go away in the sort of next 6 months at least. But the longer that copper prices stay down at these type of levels, the only sort of reinforcement that will have of the supply tightness that's going to emerge in the copper market over the next 5 years. When you look at the supply outlook for 2015 to 2020, in 2017, we will actually see a peaking in global copper mine supply. And that will be rooted in Chile, where production is set to fall through the end of this decade. And ultimately, at these copper price levels, that supply trend is not going to be reversed. And I think that's where the opportunity is for Zambia. Certainly, if they can support production enough to reach its sort of million-ton level that potentially is there, that will happen just as global supply starts to contract. And ultimately, that should drive copper prices back up to the sort of $7,000-8,000 per ton level that we've seen during the previous price cycle. So there's certainly a lot of problems at these sort of price levels. There are not a huge number of attractive investments at $5,500 per ton. But within that lies the bullish thesis for copper and why Zambia has a great story potentially in terms of its leverage to the copper price over the next 5 years.
And just one other question on the supply-demand outlook on copper. I mean, is 2017 the sort of pivotal year where we start seeing deficits then?
I think we potentially could start to see a deficit emerge in the second half of next year. Clearly, there's a huge amount of uncertainty with regards to China currently. There's a more significant deleveraging cycle than we've seen for a very long time underway in China. The sort of pressure on the stock markets that we've seen over the past couple of days will not aid the sort of normalization in supply chain dynamics in China. But if you believe that it's a cyclical downturn there rather than a sort of structural downturn, then we do think that demand growth there will remain positive, but at a lower pace than we've seen. But if that holds true, then the market will head into deficit eventually, whether it's 2016 or 2017. If supply contracts and demand is flat or growing at a very slow pace, that inevitably means the market tightens. So I think it's there's uncertainty over the time horizon, but there's inevitability in the copper market about that deficit occurring over the next 5 years, which is a strong investment thesis, particularly relative to the rest of the commodities complex.
Okay, and just on the supply side then, I mean, the things that are driving this slowdown are a decline in investment. I mean, I had some figures from Citigroup the other day saying that between 2005 and 2012, investment in copper mines increased from 5 billion to 34 billion. But this investment at current prices by 2020 could be just 4 billion. So we've got a lack of investment coming through, plus declining ore grades and some of the other issues that we've heard about today.
Yeah, no, certainly. I mean, at these copper price levels, there are a very limited number of projects that can achieve the sort of financing they need. There are also a number of producers who are losing money. Certainly in Zambia, that's the case, but also elsewhere in the world. And I think it's an inevitable fact. As part of a sort of price cycle, you will see some closures. Whether that's in Zambia or elsewhere, but that's all going to aid a tighter market balance down the road. And it's certainly not the Zambian government's role to support all producers in the country. If there are producers who aren't economic and will struggle to be economic even with copper prices $1,000 higher, then there have to be question marks over whether those projects should continue.
Okay, Ignacio, if I could come to you now from an investor's perspective, could you just talk to us a bit about how the IFC sees the mining space at the moment, copper and in particular Africa, when you're looking to invest alongside partners?
Yeah. Well, I suppose IFC, as you all know, is part of the World Bank Group. We're probably investing now more than we ever did in Africa. Overall, we're investing about $18 billion a year in all regions. In Africa, that has gone up to about $5 billion, which compares to about $1 billion just 6 or 7 years ago. So Africa is clearly a huge focus for IFC, and we see a lot of opportunities. And of course, mining sector is key in many African economies, and so I think the question for us is how can we play a role in the mining sector, but more importantly, how can we go even beyond the mining sector to benefit the broader economy that we may be investing in. I think one distinction that we have compared to other sort of financial investors, if you will, is obviously we're part of the World Bank Group looking at the broader development impact of the project. But I think B, and very importantly, is we're very long-term investors. We invested, for example, in Escondida, where we stayed in for 23 years. We're still in Yanacocha, and I think that's been going for 22 years or so. And that's pretty key to distinguish ourselves from other financial investors, is that long-term view. We all know the mining industry is cyclical. There are ups and downs. And so what I think this current downturn has highlighted for us is that we have to try to partner with people with similar long-term views. I think in the last, from 2006 to 2012-13, we've made a lot of investments in the junior mining space, and I think that was important. We built a portfolio of around 30 of those. But obviously, public markets have very short-term views, and institutional investors have often very short-term views. I think this current moment in the cycle has highlighted that sometimes public markets aren't the appropriate conduit to raise long-term money for what is a very long-term industry. So what are we doing now? We're looking at partnering much more with majors, with mid-tier companies who maybe do have that long-term view, which we have done very much in the past, as I said, with Escondida, with BHP, we're with Rio in Simandou, we were in Quellaveco with Anglo, etc. So it's very much looking at those long-term, complicated strategic projects, which may take time to develop, but again, we have the patience and the perseverance to do that. And the other thing is to also partner with private equity firms and other sort of private sovereign wealth funds and other sort of longer-term investors, and be much more proactive in how we manage the investments and ensuring that those investments have the funding to take them through the cycle. I think we can't depend, as we did before sometimes, on being able to access the public markets or any other type of source of financing. So we're looking at partnering with people who have deep pockets, who have the patience, and who can see through the cycle. And I think just specifically on copper, we have sold a number of our investments in the copper space over the last few years. So we are actively looking for copper opportunities. And seeing how we can play a role, both, as I was saying, with majors or mid-tiers, or with private equity firms. And there aren't 1,000 places in the world that you can find good quality copper assets. So, I think we're looking in all of those countries to see how we can play a role.
Okay, I mean, it's interesting that you're prepared and happy to work with private equity there. Do you think their slightly longer horizon gives them makes them better suited for this current environment for investing in the sector?
Yeah, I mean, there are shades of grey, I suppose, within the private equity space, but generally they do have a longer-term horizon, definitely than the institutional investors that would typically be in the public markets. And again, it will very much depend. We've done a lot of co-investments with private equity firms in the oil and gas sector, with the likes of Warburg Pincus. We did a East and Central Africa investment vehicle. We've done one with Lime Rock in the oil and gas space, and we've started to do small ones in the mining space with Appian Capital and the like. So I think it's a model that we quite like, where I think it assures us there are two sort of things that it comes with investing with private equity firms. One is a certain degree of control and checks and balances with management. And the second is, as I was saying, deeper pockets and not having to rely on public markets or other markets when maybe the markets aren't there. So I think that those are two elements which we quite like, and we find a good complementarity with the IFC. where we're minority investors and we can help the private equity firm in more country-related environmental and social issues, et cetera, et cetera. So yes, it's very much part of our strategy now.
Okay, thanks. Well, if we could just change tack now, Robert, if I could come to you. Robert's from the LME. One thing we haven't really talked about this morning on any of the panels is risk management and some of the tools that could be used to reduce exposure risks to very volatile prices, especially at the moment. Well, how is the LME going about talking to the sector about this?
Well, the London Metal Exchange has been pretty active in Zambia over the last few years. We've done some risk management training courses for both government and mining companies in Zambia, and we are going back again this year. So we've been active in Zambia for nigh on 100 years, which is very interesting, I think. But it is interesting to note from the discussion this morning that no one has mentioned either risk management or hedging, not one person. And there obviously, the present price environment is one which is extremely damaging to the copper industry and one in which hedging is extremely difficult to talk about when prices are so low. Of course, Zambia is long of copper. Mining companies are long of copper, and that means in a low price environment there's no point in looking at hedging, because Zambia in the old sulfide mines are high cost producers and actually in some cases are effectively underwater at the moment. But, and this is the key to all of this, you can talk about optimizing operational efficiencies as long as you want to. When copper was trading 2 years ago at $10,000, sovereign governments should be talking about locking in their investment prices. They should be looking at selling forward at those kind of prices because they represent a significant price advantage for government to plan their fiscal policy accordingly. Lots of people today have talked about corporate social responsibility and the role that companies play in Zambia. Well, if you think about that, that really is government's role. Government's role is to lock in the price of their investment in these products and to be able to use that money efficiently to uplift the population. Why don't people hedge? Why don't people hedge in a high price environment? Well, some people argue, some companies argue that their shareholders want the underlying exposure to the commodity. Well, that's a great situation in a high price environment. What do you go to your shareholders and say to them when 3 years later the price is half of what it was 18 months, 2 years ago? It's very, very difficult to argue that in this environment that you shouldn't have hedged at that point. So there are lots of ways in which government should manage this risk. There are lots of ways in which corporates should manage this risk, but you should take the opportunity when prices are high to lock in those advantageous prices. And obviously also for mining companies to look at the time between the time that they mine the copper and the time that they receive the price for their copper when they actually sell it. They should be managing that risk of those transactions through using the LME and other exchanges to manage those risks.
But in the current environment and the outlook that everybody has of rising copper prices, I don't know, 2-3 years out, I mean, it must be a pretty tough sell at the moment to persuade anybody to hedge when the price is around current levels.
Yes, it is, and copper is not the only commodity currently that is undergoing very, very difficult times. Iron ore, coking coal, thermal coal, shipping. I can run through a whole aluminium. I can run through a whole list of commodities which are in many cases underwater. It does provide opportunities for consumers in these prices, at these prices, to try and lock in the commodities that they use to make their products, particularly, for example, the steel industry. But what I'm trying to really get to is the point that one should remember these times. One should remember the times when a lost opportunity was had in the mining industry to manage its risk. One should always look in a high price environment to use instruments like the LME provide to manage your risks. Because if you don't, then in this kind of price environment, all you're trying to do is either to put mines in a situation where they can't operate, or to optimize operational efficiencies, which you can squeeze as long as you like, but ultimately that's not the way to manage risk. Managing risk is using the financial markets to lock in advantageous prices, just like you do on foreign exchange.
Okay, thanks. Jeremy, can I just come back to you and just get an idea of where you think we are in the mining cycle at the moment? It sort of occurs to me that we've got this wave of austerity at the moment that is putting projects, expansions on hold, and that's setting us up for the next phase of rising prices. I think I'm right in saying at Investec you have a clock that gives you an idea of where we are in the cycle at the moment. But we are seeing signs of some interest in the sector. I mean, you mentioned the first Quantum fundraise. We've got a couple of asset sales going on in copper at the moment, a Barrick asset and some Anglo-American assets, both of which seem to be drawing attention from a number of participants. So, could you just give us an idea of where you think we are?
Yeah, I think we do indeed have an Investec mining clock. I should have brought it along today, but if you can imagine a clock face with the 12 o'clock being bust, in other words, the worst part of the cycle, and 6 o'clock being boom, when somewhere around 2011 in the case of the mining industry, we believe that for the mining industry overall, we're at about 1 o'clock. Now, this clock is based on experience and observation of previous cycles, and generally speaking, you begin to see M&A as you get towards 2 o'clock, and you begin to see increased levels of exploration around that level. We have seen falling exploration, which tends to suggest that we're not through the woods yet, but in certain industries like gold, you've seen a lot of M&A coming in, so we think that the gold industry is probably at 3 o'clock, even up 4 o'clock, so gold's starting to look very interesting. The reason that it is interesting is because gold price has been relatively stable, which is what investors want. As you rightly said, copper is starting to show some signs of M&A coming into the market with some willing sellers. We're yet to see some buyers for those assets, but I'm sure we will do. And I think it's one of those things where various parts of the industry are in the watch phase, which is the 3 o'clock side. So, and I think what we have seen in this cycle, which we have not seen in previous cycles in my experience, is massive volatility. In say the copper price, when you had the Chinese shorting copper at the beginning of the year, we haven't, in the industry, hasn't really had to cope with that before.
And what's causing that? Is that greater financialization of commodities, or?
I think it's the introduction of in the past we haven't really seen active hedge funds. We haven't seen people who are prepared to quote unquote manipulate the price of commodities for their own ends. We haven't really seen that much. There hasn't been those instruments available. And getting back to the hedging point, is very interesting that any mining company who starts hedging would get universally castigated for doing it. I totally take the point that it's a very valid instrument that mining companies should be using, but they're not at the moment. And to hedge now at a low price would be very difficult to justify. But I think we're in the stage to sort of summarise in a case where we've had arguably a 5-year bear market. The mining industry absolutely does start looking interesting, particularly in copper, particularly in gold, not in iron ore, possibly in coal. Those are the areas that we think could be quite interesting.
Nicholas, could I ask you where you think we are on the mining clock? Do you think we're at the bust of 12? We're past that? Where do you think we are?
No, I mean, I think we'd have to sort of concur Jeremy's view. Certainly there is a lot of interest in sort of assets that have been put on the market, but I think there's still a slight divergence between sellers and buyers in terms of price expectations. But certainly another quarter or two of pain, unfortunately, will actually help bring the sort of market back together. So, I suspect that, this probably is close to the bottom in the price cycle. And I think, people see that, and I think you will start to see a pickup in activity over the next sort of 6 to 12 months. And copper certainly is the outstanding investment thesis across all the base metals. So, it will be the focus. But at the same time, as I mentioned, there are a lack of opportunities in copper. There are a shortage of really high quality assets. So I think, that's the sort of premium attached to copper versus the rest of the commodities complex.
But should we not be worried that everyone is very, very bullish on copper? The whole industry seems to be very, very bullish going forward the next couple of years. I'm just wondering what could undermine that narrative, whether, we can all see the supply issues coming forward, but the demand side seems to be less talked about, and there is an assumption that China will continue at some level. But
undoubtedly the sort of spot cathode market right now is probably the softest it's been since the great financial crisis. So it's difficult to get very excited about the demand story in that environment. And that's where the risks lie to the story. But I think, it's a question of whether that's something where we think that could turn into a genuine sustained contraction in global copper demand, or whether it's a sort of cyclical blip, and that eventually you see an improvement. And I think that's, the sort of latter camp is where we stand. And I think the majority of people stand. There isn't a strong reason for believing Chinese demand for copper has now turned. Yes, it's in a softer phase, but there are still strong drivers domestically to keep demand expanding, at least at a slower pace than we've seen.
Okay. Ignacio, where do you think we are in the cycle?
Well, I think as IFC, we try not to take a view on where we are in the cycle. I think there are much more intelligent people and informed people to see where we are in the cycle. Look, I think from our perspective, what we try to do is look at where we are in terms of portfolio, in terms of how diversified our portfolio is, and focus on the fundamentals of the project. And there's a renewed focus on where projects are on the cost curve. So, for example, in iron ore, we have a fair amount of exposure in iron ore. We can't get access to projects at the lower part of the cost curve in the iron ore space, so we probably won't be making many investments in the iron ore space in the coming years. So it really is, on the other hand, as I was saying, copper is a commodity where we currently have virtually no exposure. So we will be looking for projects at the lower part of the cost curve in the copper space. Likewise, in gold, we have a fair amount of exposure in gold, but it is also an area where we can get access to low cost curve projects, and therefore we announced a potential investment in Rox Gold just last week, and we'll be looking at maybe taking some additional positions in gold. So, trying, as I said, we are long-term investors. We can ride out cycles. So, I wouldn't disagree with some of the statements as to where we are in the cycle. It's just that we try not to make a judgment ourselves, because we will inevitably get it wrong. So, just try to focus on the fundamentals of the projects and our portfolio balance.
But the fact that you're so focused on the cost curve at the moment shows that you don't have great expectations for rising prices sort of going forward.
Well, I think it's something that we've always tried to focus on. One takes your eye off the ball in a sort of rising market. So it's really getting back into that discipline, which in theory should always be there, of looking at those low cost curve projects. And as I was saying before, not only low cost, a low position in the cost curve, also looking at the funding. So are the companies over leveraged? So in this type of environment, we have to assume that companies are not going to be able to go back to the markets for any significant funding. So is the company over leveraged? Do we have backers and co-sponsors who have deep pockets and can see them through a prolonged period of not having access to the market?
Yeah, I wanted to ask where you think the opportunities will come from to invest. I mean, will it be companies divesting assets, or I mean, where do you see those opportunities happening?
Well, I think it's a combination. So, there are companies who are divesting assets, or at least partially divesting assets, maybe in more complicated jurisdictions. Maybe some of the larger companies with second-tier projects or non-priority core projects, which are still good projects. So I think that's something that in the past we've done relatively well, coming in with majors in complicated countries. So that's something that we're looking at a number of opportunities in that area. And then with some of the juniors, we're still looking, but again, that's in partnership with private equity firms mainly, and trying to see how a consortium of funders can present a fully financed funding plan to the company. Who might be completely undervalued right now because the market doesn't have visibility on that funding. So being able to, in a way, arbitrage that, coming in with other partners to provide a fully funded plan is another opportunity.
Okay. Right. Well, I think we've got time to open up the panel for some questions, if there's anybody in the audience. I think there's a gentleman at the back there, if we could get a microphone to him. Thanks.
Morning, it's Hunter Hill. Afternoon, it's Hunter Hillcoat from Investec here. I may be crossing over some of the other panels that you'll have, but perhaps asking this panel, Ignacio perhaps in particular, how Zambia rates as an investment jurisdiction, given the uncertainty we've had over royalties, given an environment where there's intense competition for capital. What are the sort of factors you'd look for where Zambia would have to measure itself against?
So in terms of our investments in Zambia in the mining space, we were investors in Konkola. We also invested in Kawara. We haven't done any recent investments over the last I would say 5 to 6 years. Our focus in Zambia has really been to try to diversify the economy. So we have done a number of investments in the agribusiness sector. We've done a number of investments in the banking sector, telecoms, et cetera, et cetera. So that has been, as a sort of country strategy, IFC's sort of position. We have tried to support the mining sector in other ways through the broader sort of World Bank Group. IFC did do a number of sort of SME development linkages programs associated to the Copper Belt, and seeing how we could promote SME linkages and sort of increase the multiplier effect of the mining sector. And our colleagues at the World Bank have given a lot of support to the Zambian government in terms of EITI work, etc. So, as I said, I think that our focus has been there, diversification of the economy and increasing both the transparency and the multiplier effect of the mining industry. We may look at new investments in the mining sector in Zambia if were needed. There are companies who think that it would be beneficial to have IFC on board, and the role that we would play would be, to help on those environmental and social issues as a neutral broker, and to sort of navigate some of those issues. We'll see how the environment evolves over the next few months and years, but. We are willing to look at investing again in the mining sector in Zambia.
And that's post the recent changes in royalties, or is that?
Well, I think like any investor, one wants to have clarity as to what the fiscal regime is. I think the World Bank put out a recent sort of economic brief, sort of outlining the views of the World Bank group as in general on Zambia and the mining sector, and I think it's called Work for Zambia, which came out just a couple of weeks ago. Yes, I mean, as any investor, we do want stability, predictability, and that there's a fair risk-reward balance for investors and the government, and that's something we always look at whenever we make an investment. Whenever we present an investment to our board, we make that analysis in terms of, is this a fair sharing of the rewards? And we look at it very much also, we look at it from the government side to make sure that it's not out of whack in terms of favouring the private sector, but also we have to make returns for ourselves. So we also try to make sure that the IRR is also robust for the private sector investor and sustainable. So.
Okay, thank you. Do we have any other questions at all? We've got Tom down here at the front. If we could get the microphone down. No, I think it's. Oh.
Maybe just comment on pitching.
Yes, yeah, please.
Someone who's suffered through a $1.50 pitch book. That's a buyer.
Okay.
I wanted to ask, we've heard Dr. Kololo talk about how Zambia plays the highest cost for cement of any place in Africa. By the same token, we look at Gemfields, for instance, 2-year share price performance is quite exemplary among stocks. Is there any intent among the panel here to invest in non-LME traded mining commodities in Zambia?
Would anyone like to add, Jeremy?
Yeah, speaking as somebody who's followed Gemfields from the beginning, and I mean right from the beginning, what Gemfields has done is, in my view, extraordinary, and I'm not talking for invested interest here at all. They took a commodity which was unregulated and unstructured and turned it into a commodity which is now investable through a very, very well organised structure of auctions, and have done a phenomenally good job. And I think that sort of sets an example to other companies. It's not easy to think of another commodity which is similar, but certainly in the coloured gemstones, there was no chance really that the London market would ever invest in that, going back even say 10 or 15 years. Now they will, because they've seen what Gemfields can do. So I think that's an example to everyone, and they're going to do the same in rubies, in my view, in Mozambique. Does that answer the question? No.
Is there any intent in the panel to invest in non-LME traded minerals in Zambia?
Is there any interest in the panel to invest in them?
Ignacio?
Well, we're not looking at any actively at this stage.
But is it something that you could consider?
Yes, we could, but
Nothing at the moment. Okay, any other questions? No, if not, I think we're just about running to time. So if I could just thank my panelists, Jeremy from Investec, Nicholas from Standard Chartered, Robert from the LME, and Ignacio from the IFC. Thank you very much.